Hi guys, Bob Ruding here with the Mortgage Solutions team. I am going to show you a scenario today on purchasing a home. I get a lot of clients that ask me, what are rates at today? What are payments at today? What is the best program? And there's a lot of programs that they're not new per se. These programs have been around forever, but when rates were 2 to 3%, these weren't viable options. And when I started in the mortgage industry about 21 years ago, these programs were very popular. Rates were anywhere from 7 to 8.5%. And so people wanted to figure out how can I get my interest rate as low as possible. And so a lot of these programs were available and they have been available. However, when rates dropped over the last 15 years, 10 years, 5 years, they just were not good options. And so a lot of these options are coming back. And I'm going to show you today an option that is really popular right now. We're doing a ton of these, and that is the 2-1 Buydown, and that can be done on a couple different loan programs, but I'll show you kind of how it works and explain the benefits and the cons, and we'll run through some scenarios for you. Let me bump over here to the MLS real quick. All right, hold on one second here. Here we go. We're on the MLS right now. So I don't have any relationships with any of these agents, and I did find a pretty cool little, it looks like maybe a split level here in Westjordan. And I figured I'll run the scenario for you on that. Listing price is $465, 4 bedrooms, 1 bath, 1,794 square feet. I'm not going to do anything in regards to price per square footage or anything like that. I'm just going to show you if you were to buy this particular home, and I don't know who the agent is, Diana Lobato. Anyway, if you wanted to buy this house and you wanted to utilize a 2-1 buy down, what would that do to your rate? What would that do to your payment? How does that work? And so I'm going to explain that to you. A 2-1 buy down, and the way that it works is that, so I've got the scenario in here. We've got an appraised value of $465. We've got a purchase price of $465. I've got a down payment in here of 20%, which is $93,000. Now, obviously, down payment's going to depend on scenarios. You don't have to put 20% down to buy this house. The reason I'm doing it is because I'm not including mortgage insurance in this scenario. And so it just makes the hypothetical scenario a little bit more clean because mortgage insurance has some factors depending on how much you put down. So if you're going to put less than 20% down, you're going to have mortgage insurance, and that dollar amount varies depending on the percentage of the amount that you put down. So it becomes a little bit more complicated. So to keep things clean, I just wanted to run it with 20% down. And the way that a 2-1 buy down works is, so say we're going to use a conventional mortgage today, 20% down. We're assuming that you've got a good credit score, 740 credit score, 6.1% is what you're looking at on a 30-year fixed today. Now, keep in mind, I'm not saying you have to have a 740 credit score. There's a lot of different options that go all the way down to like 600 credit score. And so don't think that because I'm running the scenario as this is the only option to purchase a home at the moment. It is not. It's just one of many different options. And I'll do some options for a lower credit score and a less down payment as well if you guys would like that. But here we've got a purchase price $465, down payment of $93,000 for a final loan amount of $372,000. Now, this does not include closing costs, property taxes, homeowners insurance, or anything in this loan amount. If you're having the seller pay closing costs or anything like that, we'll get into the details on how that works. Now, if you drop down the monthly payment on this home at 6.1% is $2,254. That's principal and interest only. So if we put in homeowners insurance and if we estimate property taxes at $275 here, that does change the monthly payment. Obviously, that's going to change it to $2,629 is our estimated principal, interest, taxes, and insurance payment. So on a 2-1 buy down, how does a 2-1 buy down work? So a 2-1 buy down, the way that it works is it's 2% of the purchase price of the home. So at $465, 2% is going to be $9,300. So it's going to be a $9,300 cost. And the way that a lot of people do it is they will up the purchase price on the home. So if we up the purchase price by $9,300, that puts us at what, $474,300. So let's do this. Let's just put $474,300. All right. And so the way that would work is then we would have the seller pay $9,300 in closing costs. We'll keep 20% the same, but the seller would contribute $9,300 towards closing costs. So that would cover the 2-1 buy down for you as a buyer. So you're not coming up with any extra money. The seller is actually covering it. We are raising the purchase price, which does increase the monthly payment a little bit, but the benefit is going to be there anyway. So 30-year fixed payment of 6.1%, but a 2-1 buy down, the way that it works is the first 2 years of the mortgage, the payment fluctuates. So for the first year, the interest rate on this is actually 2% below the market rate. So we're going to drop it to 4.1%. So for your first year that you have this mortgage, your interest rate and your payment is based upon 4.1%. And what does that do to your monthly payment? It drops it to $1,833 with principal and interest only, $1,833. So you can see that first year at 4.1%, payment is significantly lower. It's $1,833. So then the second year of that, the payment is going to be 1% lower than market rate. So remember, we started with a market rate of 6.1%. The first year was 2% lower, so 4.1. The second year is 5.1, 1% lower. And that's how they come up with 2-1 buy down. So anyway, 5.1% puts the payment at $2,060.17. The third year is the final year, and that bumps back up to your normal market rate that your rate will be fixed for the life of the loan at that point, and that is the 6.1%. So for the first year, your payment's $1,800. For the second year, you're looking at $2,060, and for the third year through the other 27 years of the mortgage, you're looking at a payment of $2,299. And so the way that works is you're basically buying down that interest rate to help you those first 2 years of your mortgage on that home. And there's a lot of factors to consider, because you can take that money that you're saving, you can apply it towards vehicles or other debt to help your debt to income ratio. Typically, a lot of people are going to get a raise or more hours or something along that lines when it comes to their employment. So the likelihood of your income increasing over the next 1 to 2 years is very likely. And so the selling point is the fact that the payment's going to increase as your income increases. So it's not a big payment shock. It's not going to make you house poor. This is a really good option for purchasing a home, and this can be done at any price range, any loan amount. There's some numbers involved and some math involved and some structuring of the purchase contract. Now, if you're a real estate agent, you've probably heard about this. You've seen them. You may not have done very many before. These are a new program to come popular. I'm not going to say it's a new program because, like I said, these programs have been around for 20 plus years. But as interest rates go up, they do become more prevalent because the cost benefit is definitely there. So that's how this works. That's how a 2-1 buy down works. So a 3-1 buy down, the way it would work is you would actually be 3% lower the first year. It's cost 3% of the purchase price. So instead of the $9,300, you would be more along the lines of 3% of that purchase price. So you're going to be around $13,000 for that. But that would drop your payment the first year to 3.1%. Put your payment at, let's see here. Let's see what this payment does right here. $2,299. So $1,620. So for that first year, $1,620. For that second year, it's going to bump up 1% from here. You're going to be at 4.1. So we went from $1,620 to $1,833 for the next year's payment, and we're going to go from $1,833 to $2,060, and then you would finalize the rest of the amortization on that mortgage at 6.1%, which is the $2,299, I believe. So the end payment is the same. It's just how it buys it down over the first 3 years versus the first 2 years. And obviously on a 1-to-1 buy down, it's 1%. It drops your payment 1% for that first year. So you'd be at 5.1, and then the rest of the mortgage would be at 6.1. So a lot of the questions are, hey, does the payment go up? Because you hear a lot of people talk about ARMs and adjustable rate mortgages, and the pros and cons to an adjustable rate mortgage. These loans do not go above that final rate. Doesn't matter what the market is doing. If the market continues to increase, you are fixed in at that 6.1. So you are protected from that. Now, if the market goes down, you can refinance out of this mortgage and take advantage of a lower market rate, which is one benefit to it as well. You're kind of protected from both. If rates go up, you're protected. If rates go down, you can always refinance and take advantage. It's a good option. It allows you to get into the home. Now, you do have to qualify. One of the things I do want to point out is you do have to qualify off the 6.1%, because a lot of people out there in social media and in the internet world are thinking, well, if we do all these low rates and then this house payment goes up, these people can't afford their homes. No, that's not true. You have to qualify off of the fully indexed rate, which is the 6.1. So it's not something that you're going to qualify for less, but then as that payment increases, you can't afford your house. It does not work that way. That's something it's been that way for forever. It's been a long time since you could qualify off that lower introductory rate. So great option. That's a 2-1 buy down. It's a great program to utilize for first-time home buyers, because you can have the seller pay it. Seasoned home buyers, it's a good one for you if you want to upgrade. It does keep your payment lower. Maybe you've got a home that you're renting. There's just a lot of good options for it. Obviously, the cons to it are if you get a seller that doesn't want to pay for a 2-1 buy down, you don't have the cash. There's just some options that make it so that it isn't feasible to do. And obviously, there's other programs out there as well. But I'm just highlighting a 2-1 buy down, how it works, how it's beneficial. If you're a real estate agent and you want me to do a scenario based upon a home that you're selling, I would love to show it. I'd love to kind of maybe even talk about the house, how the home, if I can get the property taxes and homeowners insurance on that property, we can do an exact scenario based upon that home. And it's a great way to kind of market to people as well, because if you've got a seller that's being aggressive and wants to pay for a client's 2-1 buy down, if I'm looking at two homes and both are identical, but one has a seller that wants to pay for a 2-1 buy down and one doesn't, I got to be honest with you, the one that wants to pay for a 2-1 buy down is going to be a lot more appealing to me, because I can get that lower house payment. I can save some money, and the seller's paying it. So anyway, I appreciate you watching this video. I'm going to do some more videos on scenarios. If you have any questions or anything, don't hesitate to shoot me a phone call, email, direct message, PM, whatever works best for you. I'm going to post this on my Facebook, Instagram, and maybe even throw it on TikTok as well. But if you have any questions, don't hesitate to reach out to me. Thanks a lot. Have a great day.